Hi everyone, my name's John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you're aware of all your risks prior to placing any trades. Also note that in the presentation we'll be doing hypothetical computer simulated trades and or results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name's John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help you win in the markets and in life as well. Now in a moment we're going to go over the winning trade, but before we do, I'd like to talk to you a little bit about what we call an income or high probability trading strategy. An income strategy is where we put ourselves in the position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction. Meaning, we can often make money whether the market goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean we have a much better chance of winning than we would otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockeinyoursuccess.com. That's L-O-C-K-E inyoursuccess.com, or ask a question in the comments on this video, and we can direct you to where you can find more information. So let's move on. The winning trade we're looking at today is called an X4 version 17, or V17 for short. So the V17 is a high probability positive theta broken wing butterfly income strategy that we use on the XPX that requires a minimum capital of $3,500 per trade. The example size we're going to show you today is going to be bigger than that. It's going to be a $35,000 position, so 10 times our minimum size. Now this strategy doesn't have a profit target, but in general I'd expect a good month to return between 5 and 10% of planned capital. And the exit loss trigger, or the point at which we'd be out of the position should we draw down, would be 7.1% of our planned capital, or $2,500 for our example trade of $35,000. Now this is an extremely simple broken wing butterfly strategy that's slightly bullish, and really anybody can trade this that has a basic experience in option spreads such as verticals, butterflies, and broken wing butterflies. The position is going to be entered 77 days to expiration, and it's typically going to be entered as a broken wing butterfly with a 60-point wing on the lower side or the left side and a 40-point wing on the right side. Now, the trade typically runs about 60 days in duration, so it's a fairly long duration trade, but it takes very little time to manage, as you'll see, and it's extremely, extremely simple. So let's take a look at the trade. So what I'm going to do, because this is such a simple trade, is I'm actually going to go through 2 months. I'm going to go through our September expiration cycle and our October expiration cycle. So let me come into my T-log here. I'm going to pop back into our September trade and go to our entry. So this here is software, if you haven't seen it before, called OptionNet Explorer. It's what we call an analytical software. It shows us our risk graph as it relates to the position we have on. We have our options strikes down the left side here, calls on top, puts on the bottom. We're dealing with put options in this particular position. We are looking at the options that are, in this case, 74 days to expiration. We usually enter 77 days to expiration, but if we have a holiday on the Friday, which is the case here, we go into Monday and we use the next available day to get in. In this case, it's 74 days to expiration. In this here, we're going to sell 20 options that are approximately 20 points below the money. So here we have our current asset price right now is $31.7195. If we drop under that by about 20 points, we get to $31.50. We're going to sell, in this case, 20 $31.50s, and then we're going to go 40 points higher, 1, 2, 3, 4, to 3190, we'll buy 10 of those, and then we'll go 60 points under to 3090 and buy 10 of those. This would be entered as a single position, and with most brokers, it's going to be called a broken wing butterfly. That's going to give us an analytical graph that looks like this. The straight solid lines are going to be what we call our expiration line, or the value of the position at expiration at any given price point. So the price points of our asset is along the bottom. Our profit and loss is up the right side here. And the line here, or the thin line that goes from red to blue to green, is called our T+0 line. And that's going to show us the estimated value of our position at any given price point of the SPX at as of today. So this here would be our starting point. Now from here, well, first I'd like to mention that this position, when it's entered, isn't always this positive delta. Well, what do I mean by that? Well, delta is our number that's shown right here, and it's 16.6. Delta is telling us how much this position is projected to gain or lose with $1 in price movement to the upside. So if this goes up $1, this is projected to gain 16.66. If it goes down $1, it's projected to lose 16.66. Now, a lot of times these are entered more neutral delta, but it is a positive delta trade, so we are always positive. But depending on the implied volatility of the marketplace, we may get a very different looking entry. Because our implied volatility is very high in this year so far in 2020, we are getting broken wing butterflies that are really inexpensive to get into. Also notice that this position right now has only slightly over $15,000 in it. In other words, if we did absolutely nothing, which we wouldn't do, and we let this expire, then the maximum we could possibly lose is just a bit over 15,000. We mentioned before it has a planned capital of 35,000. Adjustments will tend sometimes to jack the capital up a little bit, and if you get into a low implied volatility environment, you can get to that $35,000 level fairly easily, but in this environment, this isn't going to happen. So whatever returns we get are going to tend to be much greater from an actual capital standpoint than our planned capital standpoint. So anyway, this would be our entry point. So from here, let's just take a look at the price chart. This is what the price chart has been doing. And let's go forward. So we go from July 5th to July, July 6th, actually, I believe our entry date was. July 6th to July 9th, only 3 days, and the price came down. We were positive delta. It would be expected to draw down a little bit when the price comes back, which this is what happened here. Now, when we hit our short strikes, what we do is we do what's called a rollback. So we're going to close this position out and we're going to move it. So that's two simple orders. Sell the butterfly here, and we're just going to reposition to our entry point. So we're going to sell this off. Current asset price is 31.45. We're going to go about 20 points under that, in this case 31.20. And we're just going to take the position and we're going to close it and reopen it at 31.20. So you'll see that happen here. And this is our new position. From here, what happened is the market simply went up from here, more or less. And we'll just click through this a couple days at a time here, just to show you how this progresses. So we stay in this all the way till July 22nd. We're up $1,300. Let's just jump ahead another couple weeks here. Now we're August 5th. We're up $2,300. We'll jump ahead another couple weeks. Now it's August 19th. We're up about $3,100. And from here, we will go day to day. August 20th, 21, 24. And you can see as time goes by, this T+0 line gets closer and closer to our expiration line. And the exit rule for this strategy is we exit at our maximum loss, which is a $2,500 drawdown, or we exit when the next cycle hits 77 days to expiration, and our next cycle is November, our November monthly cycle. So we have another 10 days in this. So let's just kind of pop ahead here to Friday. This is what we look like on Friday. We are at 36.30. Now, should this turn negative delta for whatever reason, we do have an adjustment on this. And our adjustment would be to take these options and start bringing them back to give us more positive delta or bring us from negative to positive. That doesn't happen here just because of the way it was entered. So if we go to the following Friday, I'm just going to ignore adjustment trades here and go to the next Friday, which is the 4th. This is going to be our exit date. And it's going to be our exit date because our next main options cycle, or 2 months out, is going to be 77 days to expiration. So we're in September. When November's 77 days to expiration, we get out. Now, we would end up closing this trade at right around a $3,500 profit. Nice profit for the month. We also overlap these trades. So we do have a little bit of time diversification going on. This is actually our October trade, which I'll show you. And I'm just going to go to its entry date. And with this trade here, it is Friday, July 31st. Our October monthly options are 77 days to expiration. Our asset price is at $32.53. We're going to go about 20 points under that, $32.30. We're going to enter our, we're going to put our short strikes there, sell 20 of those, go up 40 points to $32.70, buy 10 of those, go down 60 points to $31.70, buy 10 of those. Nice and simple. We enter, again, we're having a strange implied volatility structure in the market as we have all year, meaning we're a little bit more positive delta on entry than normal. But as you can see with the last trade, typically any kind of a normal pullback's not much of a problem. You just roll it back. If the pullback is too aggressive, that is the losing scenario for the strategy, and hit your maximum loss if it's too aggressive. But that doesn't happen very often. And anyway, this is what we have for the position on entry. And really, you know what happened with this trade? Absolutely nothing. So if we go, right, it's July 31st. If we go to August 21st, which is 20 days, no adjustments, and time has gone by. The market has gone up a little bit, and now we're up 24.60. If we go another week, or I should say 2 weeks, let's just go to September 18th. We did have a pullback in the market, so let's take a look at this. So this was the trade, right? We put this on July 31st here. We had a very substantial up move, and then we had a very hard down move. This is a very aggressive down move here from, let's see, we had from 35.80 all the way down to, we bottomed out 33.30, which is, or actually 33.24, which is where we're at now. And the trade still looks fine. So we're perfectly fine here, no issues, no adjustments as of yet, so we've done nothing. And then if we go to, let's say, I'm going to guess the second. Let me ignore trades here and go to the 2nd of October. And this is going to be the day we exit because our December options are going to be 77 days to expiration. Therefore, we're going to enter a December trade, right? And we're going to exit this one here at 14 days to expiration at a profit of right around $3,800. So that is a period. Remember, we just went through a period of, I think, 3 months. So that's going to be 90 days. We had our 2 winning trades. We had an entry. We had one adjustment on one trade and an exit, and then we had an entry on the other trade and then an exit on the other trade. So basically you had 3 days, let's see, 1, 2, 3, 4 days where you actually had to do anything in 90 days. And we had over a third, what did we have in the profit we wanted before? Around 3,500 before, about 10% profit on that trade, a little over 10% profit on this trade in that time period. And this is just a fantastic strategy, so simple to manage and very effective. And that is why I love the X4 version 17, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other fantastic income strategies as they unfold during our weekly Options Trading for Income webinars. And where you can also learn about upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I'll personally answer any questions you may have. Thank you, and I look forward to seeing you on the next winning trade.